Once a central bank feels that they've reached their last hike, it's going to trigger a risk rally.
We are at a restrictive stance, in my view. Just let this ride a little bit.
There's a lot of folks here who think once the Fed says they're done, the stock market actually continues to go down. But I think the opposite reaction is going to take place.
I don't think we need to react either way right now.
All right, so we got the Fed meeting coming up this week, right? On Wednesday, I believe. And the question is, hey, there's a lot of fears going into it, right? There's a lot of fears on a hike crashing the market, or I'm sorry, a pause crashing the market. We're going to debunk a lot of these fears, right? A lot of the stuff going on there. And maybe there is a chance that the market does, or the economy rolls over. I just don't think that's the case. Let's find out where we're at in the cycle first, and kind of debunk some of these fears, right? So first, going back to 1982, which was the previous inflation event, right? The previous time we had a lot of inflation coming into the market, putting pressure on the economy, putting pressure into onto stocks, right? And in 1982, we had Paul Volcker. Today it's Powell. We had Paul Volcker, and he telegraphed the pause a little earlier in the cycle. Here it is. The market bottomed, and then he basically suggested, hey, we're going to end the hiking cycle. The market went to all-time highs right after that, right? So the question is, if the Fed is done, do we see something like we did in 82? Do we see the market start to climb back to all-time highs? We're only 6% away from it anyway, right? So how fast can we get there? That's just something to put in the back of your pocket. The other thing, this is the 1970s inflation. You see this all the time. We're in 1970s inflation. Inflation is going to cycle right back up. But there's a huge difference here today than it was in the 1970s. And the difference is the Fed was chasing inflation in the 1970s. We saw the Fed in red is inflation. The Fed cut, and then they hiked, and then they cut, and then they hiked. So they were unstable. They kept cutting, they kept hiking, they kept chasing inflation up and down, which fueled inflation again because they started cutting. So is this the 1970s inflation? No, because the Fed is not chasing CPI, right? They're holding rates. They're focused on core, not necessarily headline. They're focused on core for good reason. This is today's macro setup. Inflation is peaked back in June, right? Inflation peaked back in June. Economic activity is starting to turn up in the business cycle. We're starting to see that, or at least it's starting to bottom from here. And the Fed can pause because core inflation is falling. The Fed can pause because core inflation is in fact falling. And the Fed is at a restrictive stance. They're very restrictive, and they can cut on any surprises. So it's not the same setup. They are not chasing inflation. They've been holding rates higher. Economic activity is not rolling over. It's actually bottoming out. So a totally different setup there. And then now the other fear, rate cuts are going to crash the market. That's what people say. Rate cuts, you get rate cuts, things roll over, and they focus on 2001, 2008. But those are special situations versus the previous cut and pause was very bullish. But for some reason, people don't see that. They don't factor it in. So are rate cuts going to crash the market? No, this is not 2008 right here, all-time highs. This is not 2008. This is not the dot-com bubble. Markets are not at all-time highs. Economic activity in orange, it already crashed, right? It's not crashing. It already crashed. You really need a black swan. Okay, and that was the difference going back to 08, going back to the dot-com bubble. Markets were overpriced already. Well, I don't want to say overpriced. They were overweight. Everybody was all at all-time highs, overweight. Economic activity started to go negative, right? And the Fed started cutting because of that, because things started to roll over. And in 01, you actually had a black swan. So that was the correlation between rate cuts and the bear market. But that's not necessarily, rate cuts aren't necessarily predicting a market crash. It depends on what's going on with economic activity, inflation, and what's going on with where's the market at? Where are people positioned? Okay, so really, if we go to the last pause, the last time the Fed paused rates, the S&P rallied 40%, and then it crashed because of the pandemic, right? But it rallied 40%. This was 2019, right? Or you could say December of 2018, 2019. The Fed paused. Here you go. Here's your pause. The Fed started to pause. The market rallied from the lows. Okay, rallied from lows, goes back to all-time highs. The Fed starts to cut rates, and the market goes up. Now it's up 40% in 2019. It's up 40%, and they keep cutting because of the black swan event, right? The cutting isn't bad. It's just that you had a black swan event, and that's why they cut. So the cut was not negative until you had a black swan. Again, our market's at all-time highs today? No. Are we seeing a black swan event? Well, it could happen, right? But that would be a bear. You can't predict that, right? That only comes once in a while. You know, we didn't have one from 08 all the way to 2020. So like you're gonna wait 8 years where the market just keeps ripping. So the point here is this is not the same setup of 08 of 2001. It's more like 2019. Markets are waiting for that pause, right? They're waiting for the market for the Fed to pause to stop increasing rates. And at the same time, we're probably going to rip to all-time highs if that is the case. And we might see that on Wednesday, maybe not till the next Fed meeting, right? So the real question is the Fed actually done here? Is the Fed actually done here? Looking at the inflation, the two main components of inflation, we got headline inflation in black, right? And it is starting to bounce. It's starting to show up a little bit. And you have core inflation still falling. So core is trending lower and headline is looking pretty suspect, right? Because it's bouncing for 2 months in a row. It's looking a little suspect. And but the market thinks this is it. There's a 98% chance that the market is pricing in the end of the hiking cycle. Okay, or at least a pause in the next meeting, right? And why is that? Well, shelter inflation finally rolling over. This was what the Fed was very concerned with. Shelter inflation finally rolling over, dropped 4/10, largest drop of the cycle. Keep that in mind. Producer prices already rolled over earlier in the year. They already rolled over back to 2% as expected. Core producer prices are back to normative levels, right? I get it. I know oil. We're going to talk about oil. Global supply chains have eased. There is no supply side inflation in the global economy. This was the root cause, right? This was the root cause. There were strained supply chains back in 2022 and actually climbing the whole year in 2021. And those strained supply chains caused inflation to go higher, right? With demand. That is not the case. We're negative. Global supply chain pressures remain negative today. No supply side, right? Super core inflation, what the Fed is focused on, X housing, looking at services, 28% of the CPI, more than half of core, by the way, PCE, which the Fed is focused on, is their personal consumption expenditure. And that's more than 28%. That thing is falling, right? We're back at, what is this, 3%? 3.12%. And this was the lowest level we had seen in a couple of years, I believe, since April of 2021, or maybe, a couple of years. Wage inflation falling. Wage inflation is falling. The employment cost index falling. Wage inflation slowing. And you don't want this to collapse. It's not going to collapse, but it is trending lower. And the employment cost is trending lower. Well, now here's the big backdrop, right? This is what everybody's worried about. This is why we're calling for that 1970s reflation again. A lot of people are, because oil is the sole contributor to the August inflation increase. We know that though, right? That's already priced in. This pumped transportation services, which is why core went up a little bit, right? So how high until oil gets the attention of the Fed, right? This is really the main culprit here. I don't think it's high enough yet. The market would be reacting. It's not high enough yet. We're not seeing bond yields start to soar. Okay, so inflation, let's say the Fed pauses. Well, the next big, fear bubble is the economy collapses, right? We're heading into an early cycle recession is what you're hearing. And I'd argue we're in the late cycle. We're actually turning up. We're looking at lagging indicators here, right? And people like to point this out. Lending standards are tightening. Yes, they are. Lending standards are at recession highs. But is that late or early cycle? Right? Is this late or early cycle? This is late cycle. We're at the highs, right? Lending standards have already tightened. We're seeing commercial real estate stresses actually happen, delinquency rates, which we're getting to next. Okay, back above pre-pandemic highs, commercial and industrial real estate delinquency rates. Okay, so we're not in the early cycles of recession. We're at the late cycle of recession. And there's a lot of more evidence of that, right? We're going to get to that. So we're in the late cycle. This is the real displacement here. This is what people don't agree with. They think we're about to head into recession. I'm telling you, we're in a recession, and we're in the recovery phase. And there's a lot of indicators that show that. This is next. Forward-looking economic indicators are telling us we're actually looking at a recovery here. Okay, economic activity is rising. Services in black have been rising. Okay. The ISM PMI manufacturing starting to rise. It's still below 50, But historically, once it bottoms out, there's more confidence. The business cycle is starting to recover and turn back up. And that's what these leading economic indicators are telling you. They lead GDP, they lead everything else, right? They have a lead. Unemployment, very laggy, right? Regional activity is starting to tell the same story. And we haven't seen this. These have been extremely negative. So this is Chicago, Philadelphia, New York State, Empire. You can even look at the Dallas Fed Manufacturing Index. They've all been negative. They're starting to point up, right? These are leading economic activity indicators. And there's a reason for this, which we're going to get to, right? So money supply, here's another part of it. Okay, you're getting more money supply starting to pick up after declining for 9 months. The US money supply is no longer falling, right? Everybody you hear M2 is falling, the Fed, and this is the longest drag on M2 that the US has ever seen. And now it's starting to bump back up. We're getting, and this just so happened to be after what? After the banking crisis, March, right? Because the Fed injected 500 billion back into the market. And even though you see the Fed balance sheet being shaved off, that billions of dollars supported banks so they could keep lending, so that the banking didn't get destroyed. M2 start to turn up right after that, right? So they saved the banking sector, and they might have some more troubles going forward, regionals at least. Global money supply has also picked up. Global M2, this is the absolute level of M2. It did dip. It bottomed in October, where the market actually happened to bottom. Interesting. And it's, it's starting to recover here. And if you look at a year-over-year rate of change, it's grinding higher. So global M2 turning up, probably led by Brazil, China, Japan. They're still printing. The ECB just tightened rates. I know they tighten rates again, and they're getting ready to cut rates as soon as something breaks again. Now, why does this continue? Why does the global economic indicators or the economic activity continue to move up, or at least in the US? This is why. But this is why we've been saying this all year, and this is just coming online. The CHIPS Act. The US government is literally trying to onshore a global, and they can't really do, like, this is nearly impossible. They're trying to onshore the global semiconductor chips manufacturing supply chain. Can they do it? I don't know. I don't know if they can do it, but they sure are going to try. They are trying to onload this, and this means they have to print money. This means they have to spend government money. All that, and we're going to get to that part with the rates going higher. $52 billion of chips to build manufacturing plants. I see it all around me here in Phoenix. Okay, 24 billion in tax credits for chip makers, 170 for research and development. So there is a lot of government spending. It doesn't come all at once. It's like a slow injection, a little at a time. And this is why I don't really think we are getting a rolling recession, but it's not going to be a full-blown recession because there's too much government spending happening. That's one part. Inflation Reduction Act, right? And what is this? Electric vehicles, wind, solar, a lot of subsidies. If you enjoy the picture here, it is Joe Biden just pouring money into these electric vehicles, wind, solar. Forget your politics. Your politics are your politics, but regardless of your politics, there's money coming back into the markets that is going to be spent on these narratives, right? They're going to be spent on these narratives. It's happening, whether you like it or not. Who are going to be the winners, right? There's going to be some winners and losers. I think legacy, traditional legacy loses. We're already seeing, some of these auto manufacturers struggle with wages. They're already underwater when it comes to creating EVs. And there's a bunch of tax credits going towards these EV. There's tax credits towards semiconductor chips and electric vehicles, clean energy, XYZ. The biggest winner here is going to be Tesla. The biggest winner here is going to be Tesla going into the next 6 to 12 months. We're going to see that. I strongly believe that. I'm very convicted on that. Now let's go to the next part. The bond market's going to crash. The bond market's going to crash. Treasury issuance, if you're not familiar with that, that is the U.S. Treasury creating debt to fund their spending, which we see is going to the Inflation Reduction Act, CHIPS Act, infrastructure bill. Treasury issuance will crash the bond market. Nope, volatility is down. Actually, volatility made a new low. Bond volatility made a new low. This is the market saying, oh, okay, collateral is fine. We're okay. And there's a real reason for that. Why? Shadow QE. I like to call this quantitative easing. Yes, the Fed is tightening their Fed balance sheet, but we're actually seeing something we have never seen before happen, which is a reverse repo facility at the Fed is actually creating more liquidity for the market. It's shadow quantitative easing here, right? There's not enough liquidity. Rates will go higher is what people say, but that is not true. If you look at the reverse repo, $1 trillion has already drained back into capital markets here, right? It peaked at 2.5 trillion. We already have $1 trillion back in the capital markets, a little over $1 trillion, and this should continue to fall. There's no reason it doesn't. Maybe it doesn't fall as fast, but what it means is liquidity is coming into the markets, and there's a 1-for-1 correlation with the S&P and this liquidity. Fed net liquidity is coming in. Fed reverse repo facility. That's it. Okay, the economy's too hot, right? The economy's, and what that does really, just real quick to capitalize on that, is the reverse repo liquidity comes into the market. They suck up all the treasuries that are being supplied by the US Treasury. Therefore, rates become capped. Rates don't go any higher. And the Fed waits till the economy slows enough where they can start cutting rates, where unemployment starts to get at 4%, job, payrolls go negative, they can cut rates, right? So rates are pretty much capped at this point. That's what I think for the most part, right? And then here's the other argument. The economy is way too hot. Rates are going to rise. No, it's not too hot. Actually, GDP, the nowcast from the Fed, Atlanta Fed, GDP just got revised lower. Okay. Oh my God, it's going to a recession. No, we're not going to a recession. Not too hot, not too cold. Perfect golden scenario for the market to continue to chugging higher, because you're not getting, you're not getting a recession. It's not, we already saw that there's too much stimulus coming in. Money market liquidity is coming in, and rates are capped at this point. Right? Growth is cooling. It is in the recovery phase. It is recovering. It is not going negative. It is recovering. You're looking at unemployment. You're looking at unemployment going out. You're looking at all these, how do I say this? You're looking at, if you're super bearish on the economy, which could happen in 2024, which we're going to look at, you're looking at lagging indicators here. The forward-looking indicators say the opposite. The lagging indicators, you're looking backwards. You're not going to walk forward, right? You're not going to lead somebody looking backwards. That's not how the world works. You're going to look forward. The backward just tells us, okay, unemployment should be rising, right? We had a lot of layoffs. We're seeing more delinquencies in commercial real estate. You're seeing things start to slow down a little bit. So GDP is not collapsing and it's not exploding higher. Perfect scenario. Okay, now here's the lag effects, right? The lag effects will crush the market maybe in mid 2024. So some of this research that came out is showing that the peak lag effects of the Fed rate hikes don't come till Q2 of 2024. So next summer, right? Next summer, all the way through the back half of the year is expected. Well, at least at this, this is Apollo chief economist. This is from Apollo Research. They're saying that these lag effects won't hit till next year. So what does that set us up for? That sets us up for a rally back to all-time highs, right? And a consolidation to some degree. We're going to get to the technicals. And if this doesn't come till next year, well, the market doesn't care then. The market's not looking at a big crash until next year. Oh, a crash? No, well, it's not going to crash, because if these are the lag effects, where are rates? Where's the pillow out? The Fed has rates at 5.5%, so they can cut. They can reverse this by the time the economy feels it. They can start reversing, and that's not going to hit the economy, but the market's going to like it. They can reverse this. They can start pumping the balance sheet again or stop shaving it off. So either way, it's so far out, the Fed can actually solve this issue as they have been, right? The banking sector, regional banks collapse, boom, Fed injects liquidity. That is the playbook here. The market is, the collateral is not going to fall. Janet Yellen, they're not going to let it happen. They're going to inject more liquidity if anything starts to fall apart. And you're not going to get inflation structurally. Yes, oil is an issue. We'll see how far it goes, but housing prices are coming down. Shelter is coming down. Rent prices are literally coming down. Rent's coming down. The core stuff is coming down. The economy is still slowing, right? We should see unemployment tick a little higher. So you really need oil to get above 120 to see a major correction. Now, in the short term here, right, the next 3 to 6 months, what are we seeing here? U.S. equities and stocks are still undervalued. So this is research from Bank of America and, Goldman, Goldman. And they're showing that this whole year, right, you've seen a lot of money come into money market funds for the most part. This is the money, really what they're doing is they're collecting interest from the Fed, keeping rates high, right? You have a lot of cash, a lot of yield off your cash. So we've seen the most inflows into money market funds, and then bonds, right? Then you have government bonds, because everybody's waiting for the recession that hasn't came yet. That is actually here, but it's not a full out blown recession. So you don't get that real capitulation in bonds. Non-US equities, but US equities, actually not much inflows at all, right? In mutual funds and ETFs, but not in US equities, not much in US equities. So what does that tell you? People are flushed with cash. There's a lot of cash on the sideline. There's not going to be a lot of selling pressure coming into the market. You're not going to get that selling pressure, and that sets you up for another rally higher if the Fed does pause here, as economic activity starts to pick up. As we do see the Fed start to pause, and projections into the future, actually, okay, we're going to cut rates earlier. As we see that, there's going to be more inflows into the equity market because people are going to FOMO in because they're not exposed. Plus, you're going into the fourth quarter where fund managers have missed out. US retail, they call dumb money, has bought the Magnificent Seven, right? NASDAQ, all this risk stuff, all the, Tesla, Apple, Microsoft, Netflix, Google, Amazon, Nvidia, right? They've missed out. Big fund managers have missed out on these big moves, and they're going to get fired in the fourth quarter. Their job's going to be at risk because they're not exposed to the AI rally. And so what are they going to do? They're going to have to FOMO in here to get this equity exposure up at some point, right? Does it happen for sure? Who knows? That's the question. Chavez live on Sunday. Had to change it up. I wanted to release it. Had something come on yesterday, so I had to switch it up here. So yeah, that's the picture we're looking at here. Debt on credit cards all-time highs. Interesting. Yeah, debt on credit cards all-time highs, and debt on credit cards has always been at all-time highs in CB7. The credit card debt has always been at all-time highs, and the market is still going higher, right? So I can pull up the chart if you want to see it on YouTube. I believe this is US markets, because I do want to, I know there's a lot of fear out there, and maybe something does bad happen right now. The worst thing that we're seeing is commercial real estate, but it may be at the end, right? Credit card loans, right? Here's credit card loans tightening. We're seeing demand has kind of, so this is tightening for credit card loans, but their credit card defaults, right? Where are the credit card defaults at? That's what people are worried. Our credit card debt at all-time highs. Like I said, debt has always been at all-time highs. It's climbed higher every single year pretty much, but markets go higher, right? Why is that? Because what that means also in NCB7 is that as credit card usage goes higher, spending comes into the economy keeps moving. So default rates getting higher. Yes, default rates are going a little bit higher, but they're not rising at a fast pace. Where are these default rates at? I was looking at this yesterday, so we can get a good picture here. Here we go. Delinquency rates. So we're looking at delinquency rates. Total debt balances. No, let's go to credit card. Okay. So credit card delinquency rates here in the green, they spiked in January of 2023. Okay. 90-day delinquencies spiked. They're back down to 8. Okay. Maybe I need to zoom in here on YouTube so you can see it a little better. So delinquency rates aren't really spiking, right? They're up. They're starting to bottom out, but they're, back in July of 2022, they bottomed out, but they pretty much peaked out here. So you're not really getting delinquency rates explode much higher. How about auto loan? No, auto loan still kind of stuck here. Can these move up? Yes, but they're not like at, they're not at huge, problematic levels yet. Home equity, nothing. Student loan still hasn't moved. Total balance, nothing. So 90-day delinquency rates, right? You hear it, but one of these things is not going to be the biggest issue here. Student loans, yeah. Check this out. Student loan debt has been going up from 2008. Credit card debt has been going up since 2008. Markets are still higher. So that doesn't really align. The real question here is, do you get a black swan? That's the real question, right? Yes, when you get all these things stirring up at once, which they're not really at high levels, that's when you might get some type of issue, some type of huge default. But so far, the Fed already covered the deposits, right? The real crash should have happened. The real crash should actually happen in March, right? When the regional banks lost all their deposits, and basically you had a big, like, imagine if a lot of people really just lost all their deposits at the bank. All of a sudden they can't pay anything off. Growth literally collapses. That's your financial crisis, right? That is your financial. It didn't happen because the Fed stepped in and insured. The US Treasury stepped in, insured all deposits were met. Therefore, people can still pay off their credit cards. They can still pay off their student loans. A lot of people they don't have to pay any student loans, right? If they're only making a certain amount of income, there's so many programs, they don't have to pay much. So the real question here is your payments, are your interest payments larger than your income? That's the real question here. So again, credit cards, student loans, not a big deal. Starting repayments October. Yeah, we'll see that. It's not a big deal. Devaluation of the dollar is why markets are going higher. Yeah, I can't agree with that. I can't agree with that. And that is the market liquidity that we were looking at. I don't even know. Did we even put it on here? I don't even know if we put it on here. But yes, that's why I'm so bullish. So if you want to look at YouTube really quick, these charts are really kind of the culprit here to why we go higher. And we've never seen this before. So I'm looking at S&P 500. Right, looking at S&P 500. Actually, let's switch this up so we can get a better look. Looking at S&P 500, or we could just go to SPY. We could just look at SPY here. Yeah, what are your concerns? What are your concerns here? And the devaluation of the dollar hasn't really started yet, right? That hasn't started yet, just so you know. The devaluation, the dollar has not started in the US yet. That'll start when you see the Fed's balance sheet start to go higher. That is the devaluation of currency. Now, that is the path, though. That is the path we're going to see. We're going to see that eventually happen, but it's not happening yet. What's really pushing up liquidity right now is there was a bunch of cash that went into the reverse repo facility at the Fed, $2.5 trillion, and that money is now pouring back into capital markets. If you're on YouTube, you can see the chart right here. It's pointing straight up. It pretty much bottomed during January. In January, when the market started to rip higher and break above that bear market trend. Right here's the bear market trend, and then it kept going higher, and we basically broke. So the money market fund liquidity is what's supporting liquidity right now. Also, Fed net liquidity too. It looks the exact same. If you go to global liquidity, no, not global liquidity, Fed net liquidity, here it is. It's starting to wedge here. So this looks exactly like the S&P. It's crazy, right? Fed net liquidity, which is reverse repo plus their balance sheet plus this plus that, and that is also starting to wedge here. So when this breaks out, markets are going higher. Plain and simple as that. That's my call, and it has no choice. So we're not seeing currency devaluation yet. We'll probably see that late 2024. Just watch the Fed's balance sheet. When that goes up, you're going to start getting currency devaluation, right? Because right now, what you're getting devalued is actually the treasury market. Bonds are getting devalued right now. The bond market is, and the Fed is not buying those bonds. So you're not getting currency devaluation. Actually, it would be if the Fed was buying the bonds or buying the treasury debt. They're not. Who's buying the treasury debt? Reverse repo facility, some other bond, because it looks pretty. I mean, rates are high. You're getting a lot of yield there. So not devaluation yet, but it is coming. 100% currency devaluation is coming. You just got to watch the Fed's balance sheet and their liquidity. How long you been trading? What do you trade? What do I trade? I trade macro trends, options, shares, whatever, crypto. Not short-term trading right now. This is not short-term trading for me. I'm looking more I'm looking at Tesla right now. I'm long Tesla, some call options, January 2020. I might even roll those to April 2024 because I think we're going to get another big blow off top here in Tesla. Right? That's what I'm looking at here. Did the Fed bail out all SVB deposits, including those over 250K? Yes, carbides. They pretty much did. There's all this technical argument. Did they do that? Yes, they did. They pretty much backed everything. And this was first they had the FDIC going. So there's all this very complicated language, but basically they came in, FDIC came in, took control of the banks, made sure all the deposits were there. And the FDIC takes this cash from all the other banks, right? All the other banks put it in an emergency fund in case stuff like this happens, but it's only supposed to be for under 250K. This time, Janet Yellen came out and said, we're going to insure everything, right? So everything was insured there. Who lost? The equity holders. The equity holders got crushed. But if you look at KRE, it bounced. Somebody came right back into the market. So depositors did not lose. And this is why the market will never crash. You're not going to see an 08 again anytime soon anyway. You're not going to see an 08 happen as much as people tell you, oh, 08 is bad. It's not going to happen because of QE, because the Fed can literally take down the balance sheet and everyone's like, oh, QT. As something breaks, boom, 500 billion. They erased a whole year of QT. They erased it in a week. That was your financial crisis. Didn't happen. So it's not going to happen. BRICS added 40 nations to devalue dollar is a shadow. BRICS. I mean, BRICS, maybe it'll take a while. Who knows? But the dollar is still the most dominant currency. The dollar is still the most dominant currency. I mean, Swift just came out with some research that showed that the dollar was the most transacted currency by far. As a matter of fact, higher than it was 10 years ago. I had that on my Twitter. BRICS, I mean, the whole BRICS thing is, people don't understand it. The world is denominated in US dollar debts. Companies in BRICS nations, they do not want Russian rubles. They don't want Chinese yuan. They want US dollars at the end of the day. They still demand dollars more than anything. They don't want those other currencies. They can't trust them. They're too volatile. So even though the government's like, oh, let's get off the dollar, XYZ, great. It's not that easy because they owe each other dollars. They owe each other dollars. They cannot just leave the dollar system, because if they default, the dollar goes higher, because now you take the circulation of dollars out. You say, I'm not paying back my debts. The dollar becomes more scarce. It goes higher. So again, people just say stuff about BRICS because it brings attention, but they don't really know what they're talking about. BRICS likely goes to a central bank digital currency where there's a basket of currencies. Therefore, they're a little more supported. We'll see how the debt goes. Who can forgive the debts? They all have to agree. They haven't agreed on anything. BRICS cannot agree on anything here, right? And so I'm still bearish on the dollar over time because we're going to devalue it. The problem is these other countries, China, Russia, Brazil, Iran, they devalue their currencies even faster than the dollar. They print a lot of currency. So it's always the dollar measured against those. So risk on. Well, it depends what you're looking at. It depends what vehicle you're trading for risk on. Right now, I think it is risk on. FedNet liquidity is going higher. RRP liquidity is going higher. The economic cycle, at least in the US, is bottoming out. Some people might say it's early, but I mean, that's how markets trade. Markets don't trade on what you see today. They trade on what is to be. And the cycle my research tells me the cycle is turning up. It's been telling me that for a while now, which is why we've been long. I've been, bullish for since I've been making TikToks actually, or going live, and the market's still grinding higher. And actually, if you look at the trend here, we're actually setting up, right? We're actually setting up for a big breakout. Let me turn off net liquidity. This is S&P 500, big wedge pattern being formed here. This is a very strong wedge pattern here on the S&P. Who cares if it breaks lower? There's going to be support down there. A lot of equity buyers. Same thing for, and I'm going to take these off. Same thing for the Qs. Same thing for the Qs. So all the bearish narratives don't really hold a whole lot of weight here. They just don't hold weight simply because government spending, so fiscal policy, and shadow QE. That's what you're getting here. Shadow QE, fiscal policy. And at the same time, who survives? Maybe not the whole market, but legacy stuff is going to get crashed or is going to get crushed. You already see it happening. But those companies who adapt to AI and can increase productivity are going higher. That's who's going higher. Tesla's benefiting from the government stimulus also. China, whatever. China's also printing. Japan printing. Brazil's printing. ECB is not yet. They're still tightening. But the US is showing shadow liquidity. Global liquidity is actually set to pick up. It's bottomed out already. So you're getting that happen. Any other concerns? I mean, I'm telling you guys, the biggest risk here is that oil really gets out of control, which is why the Fed meeting, which I'm going to go live on the Fed meeting on Wednesday. I believe it's Wednesday. Yeah, it should be on Wednesday. It's the 20th. I'll be live on that. What I want to hear is what the Fed says about oil. How concerned are they with oil and geopolitical risks and all that? And it's not like the global economies want to see higher oil because that tightens the global economy. You think China wants to see higher oil? No, they don't. They didn't leave the dollar to get higher oil. They don't want to leave the dollar. They don't want higher prices. They want lower prices. So at the end of the day, this big move in oil is probably going to slow down here around 92. I bet you a lot of traders are going to cover. There's not a whole lot of global demand for oil to just explode this way. As a matter of fact, the U.S. is pumping more. They've been pumping more. The supply of oil is going up in the U.S. The supply of oil is going up in Libya, Iran, and some other countries, South Africa. I don't know who it is, but the supply of oil is going higher. Demand is maybe inching higher a little bit also. So, it's really OPEC becoming the central bank of energy right now. But when we look at the other commodities, natural gas, low. all the commodities are not going. There's no commodity inflation, but we are at the point where the cycle might go higher. The Fed might not care. Why? Because if they chase oil, they're going to tighten rates and crash everything. There is no soft landing. They're not going to chase oil. They did not chase oil. They chased oil in the 70s, and that ended up with a very long recession, depression / stock market sideways, and it didn't work. So they're not going to chase oil. We already saw those charts. They're gonna hold rates and let the pressure do its work. 5.5% inflation. I'm sorry, interest rates are pressuring markets lower, and they're already pressuring. We're going to see commercial real estate defaults. I think Canada just defaulted. China already defaulted, even though that's not US. They defaulted a while back. So you're going to see some defaults, but they're not going to be major. You need this to reshuffle cash or capital into the markets. So all the stupid risk-taking high rate, all the companies who can't survive high rates, they shouldn't be there, right? They're going to get eliminated pretty much, or default, or go into bankruptcy. Somebody else is going to buy them out. But the companies who survive, they're going to get an extra boost because they're incentivized by the Inflation Reduction Act, CHIPS Act, infrastructure bill. Tesla benefits the most. I'm saying it. Call me crazy. Tesla's going to explode. Tesla's going to all-time highs. Dojo comes out, right? They can do this and that. Full self-driving comes out. They're already dominating here and there. But and here's the thing about the Cybertruck. The Cybertruck has a lot of interest from Tesla owners already. That a lot of them are reporting that that's going to be their next vehicle that they purchase. Number two, the Inflation Reduction Act also gives you a $7,000 500 tax rebate in 2024, which means take off $7,500 from the price. Now you get a Model 3 at $30K, $28,000 to $30,000 cheaper than all these other vehicles. Plus, those vehicles are going to have to go higher because of the automotive strike. They're going to lose workers. Like, it's the setup for Tesla has never been primed so well for a big macro move. Evergrande was major. Yep. Interest on government spending higher than the armed forces payrolls. Yeah, government. This is why the Fed can't keep rates higher going next year. They actually want inflation to undershoot. They want things to come down fast, not too fast where it crashes the economy. Because yes, the interest payments for the federal government they're almost paying $1 billion in interest. This is the highest rates they've ever paid. This can't continue because they have to refi their rates for all this stimulus they printed for COVID, for the pandemic. They have to refi those rates, and or they're gonna have to refi, all the spending that they did coming in 2024. Therefore, the Fed wants things to come down so that they can cut rates. Because when they cut rates, government spending, the interest payments for governments goes down. So they need to cut rates. But if they cut too early, it's going to be like the 70s. Inflation comes back up because now you just ease financial conditions. So they like this tight dollar. This is why the Fed will pause on September in 3 days. They're going to pause because DXY is up, the dollar's up. That tightens financial conditions. Okay, bond yields are up. The cost of capital for the market's up. That's tightening conditions. And oil's up. That tightens conditions. What do they need to tighten for? They're already tightening by holding rates where they are, right? That's already a pressure. They're going to hold rates. And if they do hike rates, that does nothing to oil. That doesn't change oil, right? If they cut rates, that does ease conditions to some degree. Capital markets move first, right? So really, at the end of the day, they're going to pause here. That is the setup. The markets are going to all-time highs in 2023 outside of a black swan event. Outside of a black swan event, that's what's going to happen here. Maybe I'm wrong. Call me out. Make fun of me. When it doesn't happen, I really don't care, because that's what I'm seeing here. That's my bet. And you got to take risk somewhere. Stay safe gets you nowhere, right? Staying too safe gets you nowhere. So that's what I think is happening here. Wave 2 FOMO is coming for the market here. Already asking for more money in October. Who's asking? Yeah, already asking for hitting the market tomorrow, up or down. Let's go. Oh yeah, what up, big man's coming. For tomorrow, I mean, in the short term, I really don't know. The market is wedging right now. S&P 500 is forming a strong bullish wedge, right? Extremely strong bullish wedge. The RSI is down. There's not a whole lot of buying pressure. Everybody's waiting for the Fed to pause. They're waiting for the Fed to pause. Well, liquidity is already coming to the market. Oh, the market is tightening. No, they're not. They're still easing by the RRP facility, right? So liquidity is coming into the market. Watch that damn net Fed liquidity. Oh no, that's global liquidity. Watch the FETNet liquidity. This thing is wedging also. I know it's not a stock, so it's debatable whether you can do that, but it pretty much bottomed back in January. SVB, it exploded. So here's the other thing: if something crashes in commercial real estate, expect more liquidity, right? If the RRP facility drains faster than the Fed's balance sheet, more liquidity, markets go higher. In almost every scenario, markets go higher, right? Not every scenario, but almost every scenario, markets go higher because liquidity is coming into the market. Inflation, the playbook, I'll get to the questions. The playbook here is act like you're in QT. You are in QT, but old school QT was everything. You're pouring liquidity out, you're removing liquidity, you're keeping rates high. There is no fiscal spending. We're getting extreme fiscal spending. We're getting liquidity from the reverse repo, and we're getting rates held higher. So it's really both at the same time. It's really smart from the Fed. And people get so politically, they think with their emotions. Oh, I don't like the Fed, they're evil. It doesn't matter what you feel. This is the reality of the markets. We're not talking about how you feel in your politics. When the Fed, ever since 2008, the Fed can use liquidity to support markets. You're not going to see a financial crisis again anytime soon, unless you get a crazy black swan, right? We had one, during the pandemic, everything shut down. That was your biggest financial crisis, recovered in 2 months. Why? Because now they have QE. And guess what? They have a huge cushion. If you're at 5.5% rate hike, something happens, boom, cut. There goes the market higher. It first dumps initially, and then it goes higher. But you need a huge event for that to happen here. Money supply going up. Let's go tomorrow. Yeah, tomorrow. Yeah, I don't know what the market's going to do tomorrow. We are at 444, 443 level. We are wedging here. So we'll see. We're going to play into the Fed meeting, where I think they do pause. I think the market does sell off this week into the Fed meeting. That's kind of been the correlation here. The market sells off, and then we get the Fed meeting, and then the Fed pauses, hits expectations. The market maybe sells off that day, and then we'll see. Watch how the dollar responds, because the dollar is key here too. The dollar is a key macro force that, if it does peak here at these levels, initially when the Fed does pause, I'm just going to expect they do pause. That's what they're telegraphing here. Watch how the dollar moves. Watch rates come down. That's actually going to ease conditions, and so they'll probably try to be a little hawkish, and then market's going to like that. So the setup is very bullish here, regardless of what you think. The VIX is low. The VIX is at making, I don't know how many year lows. Volatility, the bond market volatility just cratering. There's something, and I'm telling you, this is from the RRP. Apple should pop and bring up the market. Apple can bring the market up for sure. It's a big stock. I mean, I don't think nothing systemically is wrong with Apple at all. China's rolling over. No, China PMIs are fine. China is expanding. The retail sales just came out the other day, and retail sales were fine. They're moving up. They're printing money. They're cutting rates. China is easing right now. They're in easing mode. World's biggest second economy is easing. Like this boat is flipping. The cycle is starting to bottom here. Google, I'm watching for a call. Okay, call on Google. Amazon call. Don't forget Amazon Teslables. Yeah, Amazon. I'm bullish on Amazon, but I'm way more bullish on Tesla. Google looks good. Yep, Google looks good. Sells off, gets bought up 100%. 90% of all the money is debt. So when large defaults start coming in, consumer spending down. Let's see if I can understand what you're saying here. 90% of all money is debt. Yes, most money is debt. It is debt. So that's why you hide in asset prices, because asset prices are not debts. They're what you're storing value into, right? So when the large defaults start coming, which when they do, you just use more debt to cover the defaults. Therefore, asset prices go higher, right? That's the name of the game. Something defaults, you print more debt, you cover the holes, asset prices go up, because the smart people that are not stupid, well, first of all, you devalue the currency, so you automatically devalue the denominator, right? Everything is priced in. If you make that less worthy or less worth, everything else gets scarcer, so it goes higher. So if something defaults, assets go higher. That is the name of the game since 2018. What happened in 2008? I'm sorry, during the pandemic. Well, the pandemic, we crashed initially until the Fed dropped rates, devalued the currency by printing more money. Fed balance sheet went up. Markets go to all-time highs. As a matter of fact, they go insane. What happens in March? Banking crisis, deposit flight risk. The Fed comes out, bank term funding program, more liquidity. You devalue the dollar. The dollar actually rolled over a little bit. Boom, markets go higher. Crypto goes higher. And this is a huge setup for crypto. I mean, don't let me get into that. The biggest, I'm going to talk about this tomorrow, which is the biggest narrative in crypto is not Bitcoin. The ETF will set things off, but it is tokenization. We're seeing it. If there were to be a narrative for crypto to work here, it is tokenizing all assets. And there is one protocol that benefits from the tokenization of all assets, all central banks, right? Everything else. And that is coming near. I've never been this bullish on. I'm looking at a 10x here, easy 10x here for this protocol. I'm not selling you anything. I've written about this. We've talked about it all the time. Not XRP. It is not XRP. XRP is not. I'm sorry. XRP is not being used for this. Now I'm going to talk about this tomorrow. Join me tomorrow. We're going to go over this tomorrow. It's Chainlink. It is the Chainlink CCIP protocol is being used by the Australian Central Bank, the SWIFT network. We just got a. We just saw not just saw a video, but now you have these services. Who's the DTCC? It is the Commission for something transactions. I have it on my Twitter here. Man, there's so much information. Watch. Let me pull it up really quick. I have it on my Twitter. So there's a company who does. Let's see if I can get to it. Come on. This is important. Global payments. Where you at? Okay, here it is. So the settlements, the DTCC, which is who are they? They're the depository. Let me slow down here. Getting a little too excited. The depository. I can't even say it. Trust of Clearing Corporation. Okay, who settles most major security transactions in the U.S. We're talking equities. We're talking bonds. We're talking corporate debt. Right? They're collaborating with Chainlink, and Swift already has done it because they want to tokenize everything. Right? This is the biggest, largest catalyst. And the way you win in markets, you see the catalyst before it comes. By definition, a catalyst, most people don't have it priced in. Okay. And guess what they transact? They process quadrillions of transactions in dollars a year. Last year, they did 2 quadrillion. So when you attach a protocol to that, I mean, that is the crazy, that is a monster catalyst for Chainlink. And, everybody doesn't jump on until they see the price go up, but I'm watching price. I'm watching these catalysts come on. And I think Chainlink is probably the most secure crypto, not secure as in it can't fail, but secure as in it has the best catalysts outside of Bitcoin and Ethereum, obviously, not XRP. Tesla hasn't come close to all-time highs like Nvidia. I'm with you on that. Yeah, 100%. Tesla's not even there yet. I'm the most bullish on a couple things. Bitcoin ETF brings in trillions of dollars, opens up the retirement system, opens up pension funds, family offices, people who don't want to use private keys, right? Bitcoin, Ethereum, deflationary. Ethereum is the platform for all NFTs, right? Smart contracts. But Chainlink is built on Ethereum. Ethereum goes higher, probably outperforms Bitcoin. I'm bullish on Chainlink. There's probably other coins that go a lot higher, but their thesis is shaky. Chainlink's thesis has the strongest altcoin thesis out of all of them, by far, bar none. Not Solana. I know there's a lot of people they like Solana. I think Ethereum solves what Solana is going to be doing. It doesn't matter. It becomes, maybe it goes higher. Either way. And then Tesla, right? Palantir, obviously. But Tesla also, great thesis coming on Cybertruck, all this stuff. I mean, I'm getting excited here because I see these catalysts coming together. The macros coming together. The business cycle is turning up. The Fed is pumping liquidity. We're at the end of the hiking cycle. We're going to see another blow off top here. What else do we got? XRP replacing Swift. XRP to replace Swift. That's a tough one. How could XRP? I don't think so. They could probably integrate with Swift to some degree, but Swift is not choosing XRP. When the news comes out, it comes out. Show me an article. But right now they're using Chainlink. Swift is using Chainlink. They're experimenting to tokenize assets and then move those assets on chain. They could be using XRP, but XRP is centralized also. Chainlink is a decentralized Oracle. So totally different. I just started a window cleaning business last weekend, already 500. Hey, congratulations. Cody, hey, I have a friend that's actually doing that too. here in Phoenix. Mara, MSTR. Yeah, MicroStrategy is going to be a great vehicle for that. I think MicroStrategy does become a great vehicle for that. Vitalik is such an ethical and revolutionary out. Yeah, Vitalik. I mean, everybody's gonna have. You can always point out something negative, but Vitalik, he's not looking to make money, bro. I mean, he sold all of his. The only reason Shiba Coin's a big thing is because Vitalik literally burned like $1 billion or like $1 trillion or something. Shiba Coin, gave it away to some charity. I mean, look at the dude. Who's he gonna manipulate? PDD call on a decent one. Okay, PDD, Chinese. What is that? PDD is like Chinese retail, or what is it, like Netflix, something like that? Who else we got? Chainlink can be used by all. Chainlink is used by all crypto. It is the most widely used crypto of all. Chainlink is the most widely used crypto. They all use it to for price feeds, right? For information from the real world to the crypto world. So what's happening here is you have private blockchains, right? Companies like JP Morgan, Swift, they all have their blockchains. They're private. Then you have public blockchains, which is crypto. And the thing is, they can't interact with each other. So Chainlink allows that interaction to happen faster, cheaper, smarter, right? And so you can tokenize, and now the TradFi, right, traditional finance, can now plug into crypto and take advantage of crypto. And I know a lot of people believe, oh, crypto should be by itself. It's not going to happen, right? You got to change your thesis when it comes. These maxis think it's all about crypto. Everything else is going to fail. That's not how the world works, right? The world just doesn't work. Oh, they hate that BlackRock is coming in. That's how your price is going higher, because hedge funds are pumping the price. Family offices pumping the price. Now you're getting a secular move, an adoption, which means people's pensions can get a piece of that. They're not selling, right? 401ks, Roth, they don't sell. They hold till they're 65 years old. So now you get a full bid on Bitcoin. I mean, this is a good thesis here. Too many rug pulls in crypto regulation. Yeah, there's a lot of rug pulls, a lot of scammers. There's a lot of scammers in the stock equity market also. That's why people stick with the S&P 500. Definitely more scammers in a crypto world. So you got to know what you're talking about. So yeah, the economic cycle is turning up. There's not a whole lot of really negative things. Oil is something I'm looking out for the Fed to speak on. I'm going to be covering it. I really want to focus on what he says about that on Wednesday. But I mean, for the most part, it's like, I think Powell, unless oil really, really gets like, what's going to drive oil higher? Maybe there's some kind of secret. I don't know. But more production is coming online. I just wish crypto would replace banks and give more power to the people. Well, it will. Crypto is going to give more power to the people, but not in the way you think. Banks are going to utilize crypto to give power to the people, because at the end of the day, it's all about adoption, right? The mobile wave, mobile phones, people hated them. People used to say credit cards were trash. They could never work. But once people see how efficient they are and how much more access and freedom they have, then they're going to use it. And the big institutions are going to adopt the crypto that works, that are more secure, in order to offer that to clients. That's why tokenization, that's why BlackRock, Larry Fink, right, the biggest asset manager in the world, you could say he owns the world. The World Economic Forum is talking about tokenization, because it makes it cheaper for them. The costs are different. It's instant settlement. So all these transaction fees go away, and it's safer, it's more reliable, it's more secure because of the way the checks and balances with the Chainlink CCIP network. Therefore, you do get a safer world, and all the other banks are going to have to move towards that. They also have proof of reserves here, which protects you from this stupid collapse, because you have to prove on chain, on the blockchain, that you have the assets to back the liabilities. Therefore, you don't get an FTX collapse, or you get notified in real time, not literally 5 days later, right? You get notified like 2 months beforehand, like, hey, they don't have the assets. Therefore, Chainlink does solve a lot of those things, or crypto in general, those protocols. So I'm very bullish on Chainlink here going forward. And a lot of people don't know about it, right? They hear XRP, they hear Dogecoin, and I like Elon's Dogecoin, but I mean, I like Elon, but Dogecoin is trash, and all that other crap. I didn't sell after I had 100x on SafeMoon, was up 35K, and held that till I got a 10x. Dang. Yeah, you got to sell those things. Those things are insane. That's why it's like, you got to watch. There's a way to trade tokens to know when to get out. You're not going to hit the top, but you want to suck it. You want to at least benefit from 80% of the move, somewhere between 60 and 80% of the move. And there's a way. I'm coming out with courses pretty soon here. I don't know exactly when. I don't want to say exactly when, But I'm coming out with courses. How do you sell? Where do you sell? When do you sell? That's a tough thing. People know when to buy. Sometimes they just buy it, but when is it time to sell? Right. And I'm looking at technicals, macroeconomics, and the fundamentals of the project. If they start, if they start creating more supply, that's one. If the RSI is up, that's one. If the business cycle, which is all these things together, there's signals to sell here. Okay. And you definitely don't buy back those coins. Carbon capture will drive oil prices higher. Okay. Carbon capture. Oil prices might go higher. They might definitely go higher. We'll see. We'll see how it plays out. I don't know. I'm not going to say too much on it. I want to hear what the Fed has to say. I'm trying to gather more information on how big of a threat this is with oil going higher. I really want to see how big the threat actually is. It could slow demand further because prices are up, people stop traveling, and it could just, because what else is up? Airfares, right? What if people like just say, okay, I'm not traveling, oil prices are too high, tickets are too high. You crush demand further for oil. So what are they going to do? Keep cutting production, and then they're going to hand over the market share to someone else. So really, I mean, OPEC is really, they're really taking aim here at when they cut these when they keep cutting production here. But they can't do it forever. Digital dollar can be used to track and control all spending. That's what's coming. I mean, it's already tracked. I mean, if you use credit cards, if you use a bank account, you're already tracked. Pretty much you're tracked everywhere, just not as fast, right? So you're already getting tracked. People think, oh my God, the government's, if for some things are necessary. Your mobile phone, Apple, if you have an Apple phone, you're getting tracked everywhere. Apple has all your data. This is the world we live in today, right? Just don't do nothing stupid. Instant transaction already here. Banks and vote right? You got to vote for the right people in office. Pay attention because people say, I don't care, it's stupid. Well, vote for the right people because you get the wrong people and the wrong politicians. And now you get these stupid rules. So we just got to vote the right people, and we have to stay informed to the politics. We got to think logically, not with our emotions. We got to think logically what makes sense. The economy is important, not, oh, well, I don't like this or that. It's just like, hey, we got to think here. People are lazy. They don't think. Already here, banks hold that up to still interest overall. Instant transactions are here. Yeah, a lot of this stuff's already being built. Is the cost of electric rising at the same price as gas? Let's take a look at that. I can see it right here. Gasoline prices. Let's go. And these charts are on YouTube. Just take a look at it. I'll just throw it up there on YouTube. So we're going to look at gas prices really quick versus, well, first of all, I just know looking at the commodity in general. So we'll look at prices. Natural gas is still very low. So natural gas is not spiking. So look at energy inflation is negative here. Look at the trend. Energy inflation is negative. It is bouncing. But actually you want to go, if you're on this trading economics, it gives you like a calendar, it gives you different topics that you can choose. You want to go to consumers, gasoline prices. They're at 1. They're as high as they were in October of 2022. They are looking like they're heading back up. And what does this stand for? USD per liter. Okay. So gas prices are up, but electricity prices, where are the electricity prices? I don't think electricity prices are going up that much. They're still up, but they're not up a lot. And so all you got to do is look at nat gas. Nat gas is still getting wrecked, still pretty low there. If nat gas goes up, then I'm going to say, oh crap, okay, energy prices are going up. But then you also accelerate the transition to renewable energies, right? Are they ready yet? Probably not. So you might get another a lot of stress in the system. Debt on balance student loans. Here's a funny one. Debt on balance student loans. It's actually peaked out here, right? Student loan balances have slowed. Balances on debt on auto loans. I know this is up all-time highs. It's really about the interest payments, though. Like I said, it's the interest payments, total debt in the US. Anyways, is the cost of, oh, you're talking about electric vehicles? No, that's falling. The cost of the supercharger network is a superior network. The cost to charge your car, let's just put it this way. There's a couple of examples, and you can always cherry pick the data, but there's a lot of examples where like if you charge at a supercharger station, it's not as efficient as at your house. But if you have a charger at your house, which the supercharger networks are going to get as good as at your house, it's going to cost you about $3.50, somewhere between $3 and $5 to charge for 100 miles versus 100 miles for a car is going to cost you like $20, 15 to $20. And that is falling. Okay. Especially if you get the energy storage system. So no, electricity is falling. You're just going to buy a Tesla. That's what I'm looking for. Is the recession coming? We're in a recession. We are in a recession. We're in a rolling recession. Financials, regional banks fell apart. If you look at some of the data from, let's go over to, here we are. Let's go over to FactSet and just look at companies. Because here's the thing, stocks, the stock industries, they front run kind of what's happening in the economy. They show you beforehand. And this is kind of bearish. Oh, we got some revenue here. Okay, we got year-over-year revenue for S&P up 1.5%. And we didn't do fundamentals this week. But it looks like who's in the negatives? Healthcare. Healthcare is probably going into recession right now. Where is that chart at? Here it is. Negative guidance. So we've been in a recession, right? It's been real estate has been in a recession. Real estate is headed for a deeper recession, in my view, because commercial C&I loans, those are all in recession. Financials have been in recession, not the big two failed the banks, but they've been in recession. A lot of shaving off. Technology was in a recession back in 2022, right? When they had cut all those jobs. Meta, Microsoft, all the companies that dove, they sold off the most. They bottomed because they started cutting costs. They started firing people basically, and that increased their margins. So they were in recession, but with tech, they can cut their margins really quick. They can recover from recession really quick because they have software. They're software companies. They don't really need a whole lot of workers. Usually they're overstaffed. So you had a tech recession. A lot of people I knew, my brother's a software engineer. They were applying at Google. They were in talks with Google. Boom! All of a sudden, Google's like, we're not hiring you, or Facebook, we're not hiring you, because they cut a lot of staff. So we're in a rolling recession where the whole recession doesn't happen at once. It happens in segments. And the manufacturing sector has been in a recession. I'm saying, hey, we're starting to recover now. Services has really not been in recession. Okay. Consumer staples recession. We're seeing that happen now, which is like low-end retailers. They're in a recession. They're going to probably stay here for a while. Real estate, energy is recovering from recession. Communication services, no, not really. Industrials, no, because they're getting Inflation Reduction Act. Consumer discretionary, I think they're coming out of recession. Healthcare may be going in recession. If you look here at the negative guidance, you've seen the biggest differences. There's more negative guidance in healthcare right now than any other sector in the S&P. So expect there to be a recession in healthcare. Information technology is 1 for 1. So yeah, we're in a rolling recession. Not every, watch the unemployment rate should keep ticking up. I think it goes at this cycle up to 4%, to some degree, maybe 4.1, but there's still a lot of stimulus coming in the fourth quarter. So I don't think it's going to be that bad. Job growth, we'll see if it goes negative. Oh, I didn't even see this. There's 5.6 reasons that stocks enjoy a year-end rally. What else we got here? Bonds are a great investment. Maybe. I mean, I don't think so. I think it's good to keep some bonds because they're at the, bonds are basically at the lows. They're not going much lower from here. There's a lot of income coming into bonds. But if you were to like weight in a portfolio, I would say you don't want to be more than 20% bonds or treasuries. You don't want to be more than 20% treasuries, because if growth is rebounding, there's not going to be a whole lot of because bonds go up when there's a recession. Bonds go up when economic growth weakens. It has already weakened. It's been weakening. Remember, this is the worst year ever for the 60-40 portfolio for bond holders and equity holders. This is the worst. Bonds sold off with stocks. That's never happened before. Usually you get bond sell off, stocks sell off, bonds go up. Stocks are selling off because the economic cycle is turning over because growth is dropping. So you go into safety. Bonds are the safe haven for economic growth slowing. But this time you had inflation, so bonds couldn't go up because inflation was higher. You're paying a higher cost for inflation than you're getting a return on your bond as far as the yield. So bonds are in a tough place. I'm not saying they don't belong in a portfolio, but I don't think they're better than equities or crypto when you're looking over the long haul. I don't think it's even close. Bond holders are underwater. They've been for a while. This is why we're getting a regional banking crisis too. Bonds are so underwater right now that, they're so underwater when they do mark to market, when they have to show their assets versus their liabilities, they're in negative. Therefore, they default. Therefore, they have to sell off this. They have to sell off that. So bonds, are they a great investment? I don't think so. I think they're a way to stay protected to some degree. Is going door to door a good marketing strategy for starting out a window cleaning business? That's not really a question for me. There's a lot of components that is going to factor into, but that's not a question for me, man. I'm sorry, I can't help you there. But my friend does do that, and we talked about it. And I think the thing was, where are you located? What are the demographics of people you're going after? Is there something you can do online to give them services? Can you create something online where they can look at it for free? You can send them a virtual card. I don't really know. There's, that's outside of my purview. I'm not an expert on that. So yeah. What does he do for marketing? He does go door to door. No, you're good. He does go door to door. He does he made a card. So he made a card and he hands out his card. And I told him to focus on Alex Hormozy. Go check out Alex Hormozy. You guys probably heard of him. He's good with business, and just go through his content. I mean, I really don't know. It's always comes down to research and trying to figure out how that works out. So I would check out Alex Hormozy for sure. Anyways, yeah, let's go through these S&P. What is S&P looking like? Because we might get some downward revisions here. It looks like S&P 500 expected year-over-year revenue growth of 1.5% for Q3, which would be the 12th straight quarter of revenue growth for the index. So we're barely, revenues are coming in strong. Energy has the worst revenues, materials, information technology. The reason the revenues are negative is because energy costs came down a lot. Now they're spiking. So this is why markets tend to front run the economy, because prices happen now. Energy costs don't filter in through for a whole quarter. How about EPS? S&P is expected to report year-on-year earnings growth of 0.2. I think we've already seen this. First time we're positive since Q3 of 2022. So the S&P is now positive. First time. This is why I'm also pretty bullish here, especially with the RRP coming in. Positive guidance. Earnings have basically bottomed out here. This is a good chart. SPY puts, SPY and Apple puts, then calls. Big Man's coming, got that trading strategy there. Yeah, that's a trading strategy. I would have to look into it. Look at that wedge pattern. Earnings are starting to lift here. I see Big Man though. I see Big Man. So yeah, bond volatility coming down. What are we at? Let's do some Q&A. If you guys have any questions, any answers, any questions, let me know. We'll do some Q&A. And if not, I mean, I'll see you guys tomorrow. But yeah, let's see if you guys have any Q&A, anything to ask, any other questions I can debunk when it comes to the bear market. Like, I'm not, just hyper bullish no matter what. Obviously, if earnings estimates come down, if the Fed hikes, the market's going to struggle, but we're still in the uptrend, right? We're still in an uptrend if the Fed hikes. If oil keeps surging, then that's going to bring bond yields up. Possibly at some point, they're going to have to adapt. If that reverse repo liquidity starts to come back into the reverse repo and stop holding up liquidity, yes, if the Fed net liquidity turns down, that'll be negative. So there are some negatives here, but the trend doesn't really show that. Oh, I'm not even on the technicals, but the trend is not showing that. I mean, not the trend. When I add up all the variables together in a basket, it doesn't point to recession. I'm sorry, it doesn't point to markets rolling over, right? So it just doesn't point that way. We're still in this uptrend. We've been in it for a while. If we turn on the moving averages, right? There's going to be buyers here at this 100 daily moving average. We're below the 50. We might retest that. We might just be wedging here, but that's a good setup. Okay, if we go to the weekly chart on the S&P, where are we at? We're way above. Oh my goodness. On the weekly chart's even more bullish because we're above this big 4,200 level, which we've been above, and we're wedging. This is very bullish. I need to take a step back sometimes. We could be wedging here, right? You get a big wedge and you get a big breakout for the S&P. And now you're getting, when you see the 50-day moving average start to get vertical, the slope goes up. That's very bullish. Very bullish. You're getting an increase in the slope. Hold on. Let's make this bigger. Oh, is that what happens? It kind of looks dumb. All right. So you're getting that slope. Now, again, what's going to fuel this market? The RRP. reverse repo. Remember that. If I taught you guys anything, it is that you have a you have the Fed really still. I don't want to call it the Fed, but you do have money leaving the Fed. You have another facility that is giving liquidity to the market, and this thing is pointing straight up, and it's going to support the bond market. Oh, AMD looks really good. I like AMD. Keep an eye on AMD. AMD looks really good. And then look how close that is. Look how close the S&P is to Fed net liquidity. Pretty one for one, right? The market did front run Fed liquidity. It did break out. And I called this back in the day. What was this, in May? Remember when I had that video on TikTok? I wasn't on YouTube yet, but I had that TikTok video and I said, if we get above 4,200, the market is going to squeeze. Breakout traders are going to step in, and FOMO buying is going to happen. Everybody thought we can't get above that level, and we're going to go on a FOMO run. And we did. Now I thought we would continue in July, but we didn't. We slowed down, but now we're consolidating. Okay, we're grinding, we're waiting for the next bull run, right? At least I am. Oh, there we go. We got some good questions there. I'll get to you guys' questions. My bad. Hey, remember, if you guys jump on, hey, don't forget, if you guys don't mind, jump over to my YouTube. If you think I bring you some value, I'd appreciate if you guys help me out the algorithm. I'm trying to get up to 1,000 YouTube subscriptions. So if you guys don't mind, jump over to YouTube, help me out there, subscribe, hit the like button, give me some, so you can give me a little boost on the algorithm. It's tough over there on YouTube, and I would appreciate that. Plus, if you ask a question on YouTube, the comment sticks, and then I can look at it, I can post it, it'll be saved, right? It'll be saved on there for other people who they might have the same question as you. Where TikTok, it gets lost in the feed. And then also I have my Instagram, my TikTok on there, free newsletter on the link in the description on YouTube. So it's a lot easier on YouTube than it is on TikTok. So AMD looks really good. I like the setup on AMD. Let's take this Fed net liquidity off. Pretty simple for AMD here. I'm just going to make it simple. And I got the charts here on YouTube. AMD this is a falling wedge pattern. Okay. This is a falling wedge pattern, and it's setting up for that falling wedge. It's above the 100. I think we get some more support at 98. I would say that, AMD, anything above 100, anything that holds 100, I know like it could go to 98, but once you get that hold of 100, pretty nice hold there. The RSI is pulling back. AMD is it should explode at some point. I'm just waiting. You want to wait for the momentum to come in, but this thing is looking very well. Like it's in the uptrend. It's still holding the uptrend. Maybe you want to see Fed net liquidity turn up. I'm waiting for the signal. I'm more bullish on Tesla in the short term because Tesla, there's a lot more confidence. There's a lot more people negative. That sets you up for a good bull run. There's a lot of negativity. People say, oh, it's going to crash. It's like, great. I hope you think that so we can squeeze you higher. Yes. 100 downside, look out. Yeah. AMD. I'm not in AMD yet. I'm waiting. I'm not going to buy at the lows. I want to see it consolidate a little more. I want to see the RSI capitulate. I want to see some momentum, a narrative, possibly catalyst come into the market. Looks like it's going to retest 99, but it is looking good. So if it hikes, the DXY will go up. If the Fed hikes, dollar's going up. Yes, the dollar's going up, and that's going to cause more. That's going to cause more havoc in the market, depending on how fast the dollar goes up. If the dollar explodes higher, that's going to crash. I don't want to say crash the markets. I like to say that in the intraday, but it's going to put pressure on the market. If the Fed hikes, yields go up, dollar goes up, and that means we're going to consolidate even longer. We might even break the downtrend. I doubt that's the case, but I mean the uptrend. So yeah, if they pause, I think the dollar eases here. I think yields ease here. They're at the cycle highs. They start to slow down. So that's my view on it. You think going down more or up? Lost SPY 44.44, so I would think down chop. Yeah, down chop into the meeting, possibly. I think that'd be the better scenario, is that we down chop into the meeting. Yeah, but the dollar, dollar's at a very critical resistance level. Has a lot of momentum, but I mean, I think you look at the RSI, I think it's almost done here. It should be done here. I think it's just waiting for the Fed to pause. But then again, the Fed comes back November 1st. They might hike. So that causes more issues. So it's like we might just consolidate right into the end of November. But they could hike and say we're done here. So well, actually we have all of October. My bad. We have all of October. Which means I think if they pause here, everything rolls over, and then we come back in November to see what happens. So I think I think things roll over. I think by Thursday, Friday, we'll see. And I always look at week ahead, but you got to think ahead. And I think this is it. I think rates come down here, or at least slow a little bit. I think the dollar does slow here. Should get bought up, typically does after the meeting. Let me see where are we at with the S&P really quick. Yeah, so yeah, this is S&P. So we could come back into this 100 daily moving average. That's a really critical or really fair assessment, I think. Right? Boom. Hey, thanks for the sub, Iron House. Appreciate it. So you could see this, right, over the next couple of weeks. Boom, maybe back up. Basically, you're wedging. It doesn't mean this will happen exactly, but this is a very bullish setup. This is a very bullish setup. We just got to watch these moving averages to see how SPY actually moves. I don't see a reason for it not to go up, especially with liquidity coming back in. And yeah, it's a very bullish setup. I'm going to turn over to... So everything is on sale. Not everything, because listen, there's still companies like PayPal who are going to struggle. I think this is a stock pickers market, meaning those who have good balance sheets, those companies who have adoption, they're using AI. They can actually grow their margins in a slower recession slushy environment with rates elevated to some degree, because the Fed might hold here. Look, I'm not saying they're going to cut this year. I'm thinking they hold, and they'll probably hold into 2024, right? There's reasons they could cut, but the more likely scenario, they just hold. If they hold here, you're still getting elevated rates, but you're going to get companies who struggle. That capital is going to flush out. They're going to fail. It's going to go into the companies who can benefit from, that capital moving. Tesla's growing faster than 5%. So it doesn't matter. They don't care about 5% interest rates. It does affect their business to some degree, but for the most part, when it comes to investing, people are going to see these narratives and they're going to go wild, right? Oh, excuse me. Wait till BTC is 1 million per coin. You think 26K is expensive now for Bitcoin on sale? Yeah. Bitcoin is on sale. I'll tell you that right now. Bitcoin is on sale. Maybe it drops to 21, 22K, but Bitcoin is on sale. I think Tesla is on sale also. Let's see, Tesla. I have this thing marked up like crazy because I've been trading it, but I think Tesla's on sale. Look at this trend. We're in the uptrend. I mean, one more pullback would be nice, because then you get something like back here where it pulled back and made a lower high, pulled back again, and then that was it for Tesla. Oops. Actually, let me make this bigger so you guys can see it. There we go. So Tesla I think Tesla's on sale too, especially once it gets above 300, 315, it's off to the races. Big blow off top here. You got Cybertruck coming online. A lot of narratives there. Still holding anchored VWAP. I can see Tesla come back to 260, and at the lowest, maybe 250. I think 250 is your low here. Really, because you got anchored VWAP and the trend is still in place. So maybe back to 250 would be the last move. And you're really looking at the cues. You're looking at the cues and you're looking at everything else. But yeah, Tesla's still in an uptrend. That 200 daily moving average is starting to now go higher. The 50 days flattening out. Yeah, that's what I think. Ethereum on sale. Ethereum's definitely on sale. Still in that falling flag pattern. Still holding anchored VWAP. I mean, it's right at trend. It's right at the trend. Yeah, but Tesla moves really fast. You're right. You do have to get in on pullbacks. You got to be like zoned in on the date, because it'll get super oversold on Tesla, and you're looking for that capitulation in the intraday. So you want to get it oversold into a level like 260 or 250, and you want to see price just go and then just boom. You just see this big green. a hammer candle, and you want to get in on that hammer candle when the RSI, like it's more of a trading thing. But yeah, you gotta get Tesla like on those sharp pullbacks when it's still in a bullish trend structure. But Ethereum is on sale here. It's still, I mean, Ethereum looks really good. It's just we're waiting for the ETFs, right? We're looking for the ETFs. It's coming. Tokenization is coming. This is the easiest. I mean, this is the easiest. Goodness sake. Last time we were here, right, we were recovering for Ethereum. And I'd say, like, compared to this cycle, we're looking at something. Remember, this was the pandemic. So this was nasty. This is the pandemic. I think we're more like this, right? We're right here. We broke out, and this was the bull market. Then boom, pandemic obviously slow. You had a black swan event, right? You can't predict those. You had a black swan event. But guess what happens if you get a black swan event? If you get a black swan event, the Fed, Fed cuts rates, Fed pumps liquidity. So, because then your inflation problem is done. So I think we're there. I think we're at the cycle where we're ready to break out here. 0 to 60 real quick. Yep. Very true. All right. Well, I mean, I think that's it, right? You guys don't have other comments. I don't think you guys have any other comments. I'd say the most important thing is this week I will be live on the Fed meeting and interpret that. What Jerome Powell says. I think he's going to pause. Shelter inflation is coming down. Job openings are coming down. Wage inflation is coming down. Gas prices are the only thing up right now. And so I want to hear what he says about that. Reverse repo liquidity is a signal for me in the macro cycle that whoever is in the Fed's facility, whoever is speaking with the Fed, they're already anticipating that the Fed does pause and ends the hiking cycle. Therefore, that money leaving the reverse repo is literally signaling we know something. In my view, we know something that others don't. So we're leaving. And I think what it is it is no longer going to be a deal to be in the Fed reverse repo. I think it's going to be a better deal to go somewhere else. Okay. Well, government spending's fourth quarter, Inflation Reduction Act's coming in. So you have a lot of stimulus still coming online. I don't see a recession, a full-blown recession coming. We're seeing pressures ease in the jobs market. Some, there's a lot of layoffs here, layoffs there, but you're not seeing a global, not seeing a big black swan event. So I think that continues, and we get unemployment maybe peak above 4. What up, pack of lettuce? Maybe peak above 4 a little bit. Pack of lettuce, you got to jump on the YouTube so I could do your technicals on your stuff whenever you can. Yeah, I think that's the case right now. That reverse repo liquidity is coming in. Something breaks, Fed goes higher. I mean, market goes higher. And I've said this ad nauseum, right, over and over. So just want to get it in the head. And the economic cycle's turning up, right? That's what I'm probably the most covered calls. Let's let it go to zero. I think that the economic cycle is a big one. So when you throw on, do I have it up here? Yeah, the economic cycle, like it's so privy to risk assets. Like this is one of the secrets that, look at ARK Invest. Crazy. How is it that ARK Invest looks exactly like the business cycle, what I call the business cycle? It looks exactly like the business cycle here. All right, let's remove these moving averages. Let's see. Yeah, so look, it looks exactly like the business cycle. Isn't that crazy? Oh, you can't see it, my bad. All right, so look at that. I was looking at this yesterday. This is basically, well, I guess you have to go down here, kind of mess that up, because the red represents the contraction zone for the ISM. Okay, so ARK literally is the business cycle, right? Not itself, but as in risk assets respond to this, and the ISM is starting to pick up again. ARK, as soon as it started to pick up, ARK sniffed it out, or risk in general, risk investors sniffed it out. These are hedge funds, market makers. They know this thing can explode and go much higher. So the alignment is here. We're looking at a new bull market. That's all I got for you guys. Appreciate it. Appreciate you guys joining in. Again, I'd appreciate your support if you just jump onto the YouTube, sub, I'll be live tomorrow, 2:45 Eastern time. I'm going to talk about Chainlink, I believe. I'm going to go in a little bit about Chainlink because this tokenization cycle, right? You get the Bitcoin ETF and you have tokenization coming online, and it's going to be huge because we haven't had a narrative in crypto where it actually reaches, where it's actually touching traditional banking, central banking, right? All asset classes are going to merge. Not all asset classes are going to merge, but this technology is going to cover and touch everyone. So this is a big deal, right? It's not going to get realized for a while. People say, brush it off my shoulders. I'll see it when I see it. And then it's going to happen. Either way, catch you guys later. Have a good Sunday. Stay blessed. And I'll catch you guys tomorrow. Make sure you get a workout if you haven't worked out yet. Peace.